I'm Diego Sanchez, president of HousingWire, and this is 10-Minute Talks. My guest today is Sam Bjelac, SVP of Third-Party Origination at Carrington Mortgage Services. Sam, welcome to 10-Minute Talks.
Oh, thanks, Diego. I appreciate you having me on today.
It's so great to have you on. Before we dive in, could you give a 60-second introduction of yourself and Carrington Mortgage Services?
Sure. I'll start with the company first. So Carrington was started in 2003, so a little over 20 years ago as an asset manager, managing mainly mortgage-backed securities and single-family assets. The company's matured through the years, opened an origination platform about 15 years ago, a third-party platform, I guess now about 13 years ago, and is developed into a Ginnie Mae master servicer, formed a big, large book of servicing, roughly about $150 billion, and currently operates in 48 states. And then as far as myself, so I've been in this business for about 20 years, all in wholesale and correspondent. I worked for large institutions on the GSE side, as well as some of the largest companies on the non-agency side.
And you recently joined Carrington.
Yes.
What excited you about the company and your new role?
Well, a couple things. Actually, I was very fortunate. I actually worked at Carrington prior to this. I helped start the third-party platform with a group in 2011. We had a small group in Southern California with a handful of licenses, and we built the company to be a national mortgage originator aggregator. I left the company 2017, went off into the non-agency and non-QM space, and an opportunity arose to come back and help them further grow their company. I kept in touch with a lot of the executives and people that have been here now for 10 plus years, and I just felt the timing was right to come back.
So this is a return
exactly.
To an old company. That's great. That can actually work out really well. You run the wholesale channel now at Carrington, but the company has several other channels that they operate in. Where does your business sit in relation to the other channels in terms of company priorities?
So I sit over the wholesale and correspondent divisions. That's what we call that third party. We do have a retail origination platform, mainly that services the book or that works with the servicing book. And like I said, that's a very large book out there. And then we do some whole loan trading and purchase mortgage-backed servicing rights. So I think we all align together. We're kind of vertically integrated, from the origination and aggregation of the loan to the underwriting and credit. Everything's done onshore here in the United States. And then to servicing of the loan. And then in any case, there has to be a disposition of the loan. We have, a company that takes care of that also.
So it sounds like there isn't a big growing retail presence, distributed retail presence that you're competing against. The consumer channel is more focused on the servicing book.
Yes, sir. Yes, sir.
That makes a lot of sense. All right. So third-party origination has been kind of taken over by a couple of names over the past couple of years. UWM and Rocket are big. PennyMac is also big in those channels. How do you plan to compete with some of those behemoths in TPO?
Well, first of all, these are some great companies, right? They're publicly traded. They've got war chests full of money, and they've done a lot of great things in the industry. From back when we started the company, again, we opened in 2011 when a lot of companies were closing wholesale. When I was approached to help start the company with this group, people were like, why are you going to start wholesale? Everybody's closing wholesale, right? So you have to be a little bit entrepreneurial. You have to roll up your sleeves, a lot of hard work, and just a little bit of crazy in there too. So what we've always been based is a solutions-based lender. So we've never been one to kind of move with the masses towards the higher credit, maybe, plain vanilla type of things. Carrington's kind of built a reputation over the last 10 or 12 years on some of the lower FICO Ginnie Mae business, because we service that business. That's very important. So when you work with challenged credit and kind of the underserved market, you want to be able to make sure that you can work with them all the way through the process. So not just originating the loan, selling the loan, and have someone else collect the payment. So I think that's what sets us apart, solutions-based. And over the last couple of years, Carrington has kind of moved also into the non-QM or non-agency space. And I think that's where that manual underwriting, that expertise in credit really will shine through. And that's one of the reasons I'm here is to make us a top 10 non-agency lender, as well as keep servicing the customers that bring us those lower FICO Ginnie Mae type of loans.
And is the goal for Carrington to service most or all of the mortgages that get originated through your channel?
Yes, absolutely. That's been ongoing now, and for forward in the future.
Makes a lot of sense. So, all right, seems like we're maybe, fingers crossed, coming out of a very difficult housing market. Mortgage rates are up again, so things might quiet down for a little bit. But we've been seeing some green shoots in the housing market for a couple of months now. What's your growth strategy for this year and then for 2025 as you look at this market that maybe, again, fingers crossed, is coming back?
I think we'll stick to our guns with the solutions-based lending. Working with providing liquidity where others don't. So that will be again with the Ginnie Mae portfolio that we have and the strong credit team that we have there. And then also alongside of that, again, with the non-QM business, providing liquidity to self-employed individuals, people that typically couldn't qualify for a traditional mortgage, where they're self-employed, they have a higher credit score, they have plenty of liquidity, but for whatever reason, either they have complex tax returns or they have a good accountant, they can't qualify for that traditional mortgage. So we're going to leverage our credit expertise for that. Also working with investors, people that own multiple rental properties. They want to close in an LLC. Again, they don't want to use tax returns to qualify. Typically, we use cash flow from the rents to qualify. And then even on asset utilization, where you have a higher net worth individual that maybe sold a business, we have loan programs, credit programs where we can qualify them for a loan. So it's going back to our roots, which is managing credit, managing payments. We'll still be kind of a hands-on, high-touch underwriting credit type of company, but we'll be adding technology through there to make it easier on our employees as they do these types of loans.
I was interested to hear that you're diving into non-QM a little bit more. What do you expect the makeup to be between conforming and the non-QM business for your channel?
Yeah, I think, like normal conforming, like say GSE, Fannie, Freddie, we're not much of a player in that type of business, but for the government side of the business, I think it'll still be a heavy concentration. It won't be more than 50%, but I still think it'll be kind of in that 1/3-ish range. And as we grow the non-QM book of business, I think that can grow exponentially. We've touched upon it a little bit in the last couple of years, but really not expanded on it to what I think the possibilities are. It just hasn't been. It's been a nice thing to have, but we haven't been a main focus. And I think we're going to make that part of 2024, 25.
Yeah, I've spoken with leaders at Mr. Cooper, New Res, Flagstar, some of the other companies that are building up big servicing books. Does Carrington want to compete with those folks and build one of the biggest books in servicing?
I don't think we'll build one of the biggest books, but I still think we'll build a quality book. We're not want to be aggressive on pricing mortgage servicing rights. There's a lot of folks out there that give some higher multiples. We're an active buyer of mortgage servicing rights, so we're a little more conservative on how we price them. So I don't see us being one of the largest servicers out there, but having a good quality book of business that we know will perform year after year. That's kind of the space we'll be in.
How are you feeling about the next couple of months in terms of the housing market and the opportunity?
Yeah, I mean, I think if you asked me 3 months ago, I thought I'd kind of be with the rest of the group thinking we're going to see, multiple cuts this year. Now we're seeing kind of a maybe stagnant interest rate environment. Altogether, I don't think that's horrible. I think, if we can, keep chopping it out here, I don't like big swings. So if it's something where, hey, we've got to grind it out the rest of this year and maybe we see some cuts next year, I'm fine with that. We're positioned to work in that type of space. So yeah, I think it's something we're just going to have to keep focused and keep our head going forward and work on what we're good at.
Sam, really appreciate you taking the time to join me today. I thought we had a really good conversation.
Yep. Thank you so much, Diego. Appreciate it.